Hello and welcome. This is Business Incorporated coming to you live from Lagos, Nigeria. I'm Chimeze Obi Iwago. Thank you for joining us. And coming up on the show, IMF South Africa's growth forecast for next 2 years. And Angola's central bank eyes move towards Kwanzaa flotation. Plus, optimism booms among Davos CEOs on global economic outlook. Now let's get the show started with the markets. And here on the African continent, profit-taking continued at the Nigerian stock market today. As at midday, the index was down 0.32%. Egypt was also in the red, down 0.30%. For South Africa, outperformed, gaining 0.76%, despite the subdued growth forecast by the IMF. In Nairobi, the index closed in the red on Monday after the central bank held its benchmark lending rate at 10%. And in the Middle East, stock markets were mixed in early trade as petrochemical stocks supported Saudi Arabia, while blue-chip Emma Properties dragged down Dubai as the stock went ex-dividend. The Saudi index climbed 0.35% at intraday as 10 of the 14 petrochemical stocks rose on the back of strong oil prices. Saudi Cayenne rose 1.3%. Qatar's index edged up 0.47% as Amal Holding gained 2.3% after saying a unit had spent about 179.5 million reals buying residential assets in Doha, a deal which would boost the unit's revenue by about 9% on year. But Dubai sank 0.65% as Irma tumbled 5.5%. Now, Monday was the last day for shareholders to claim a 0.42 dirham special dividend related to the listing of Irma Development. In Abu Dhabi, the index was up 0.31%. We move over to Europe now. Markets there posted solid gains during early trade following news that lawmakers had secured a deal to allow U.S. government operations to get back into action. Let's get the latest from Annette Wisbert, my colleague at the Frankfurt Stock Exchange. Hello, Annette. Good afternoon. Just wondering if we've said Happy New Year this year. Happy New Year, anyway. Now, the European stocks posted solid gains in early trade as U.S. lawmakers averted a government shutdown. Any idea how long this jump will last and what should we expect next?
Well, actually, there are people who are suggesting that this year will be a really good year again for equities, at least the first half of this year. Some are eyeing already the 30,000 mark for the Dow. And also, just today, the DAX, the German benchmark index, hit a new record high. So the mix for equities, one has to say, is really very good. We have stellar economic growth in Europe, but also in emerging markets, which is, of course, very important for companies here in Europe as well, mainly Germany. And then we still have very low interest rates, which is positive as well for earnings. And then overall, I think the absence of a major crisis, wherever you look in the world, is helping equities to new record levels also this year. As I said, to reiterate, there are many people who are believing that the bulls will be very strong also, at least for the first half of this year. So we watch out that earnings season, which is about to start, at least for Germany. And it's widely expected that we see that strong picture also in the quarterly earnings of the big corporates in Germany.
All right, we'll wait and see amongst the bulls and the bears which one takes the upper hand. Now, how much of the IMF's new World Economic Outlook report released on Monday can be considered a boost for the developed markets?
Well, actually, the IMF is very positive about the growth outlook. They're also upgrading the growth outlook for several years on average for the world economy. But they're also warning that there will be an end to the super cycle. There will be an end to this economic growth scenario, and that now it's the time to actually enact reforms, that after that economic super cycle we're in right now, the IMF is also saying that, that we are in a good position to also weather the storm which will come, because economic cycles are coming and going. So yes, it is a boost also for the developed world, because it's clearly that they're saying mainly it's Europe also who's growing a lot better than expected. So it's really the old world which is doing very well currently. It's not so much Asia. It is, as I said, Europe, and there's also some short-term growth momentum expected from the tax reform in the United States. So this should give the US another boost when it comes to economic growth. So all in all, the IMF is painting a very rosy picture, but they also have to warn, and that's what Christine Lagarde was doing when she was speaking in Davos.
Now in Germany, economic machine roars in January, with latest reports showing the ZEW expectations at 20.4 reading versus 17.5 forecast. What are the chief drivers of this indicator?
Well, it's actually astonishing because it's consumption. The German consumer is really back. Nobody had believed that so much, because Germans are traditionally not very good at spending money. They're better at saving money. But here it's the German consumer mainly which is driving that economic success story. So the ZEW is a bit of a different animal than the IFO index, because the ZEW is done among investors and people who are participating in the markets. And these people are very positive. If you look at the current assessment, the current economic assessment, it's at a record level. It was never that good since the inception of that index, and that was back in 1991. Also, the outlook component is extremely bullish. So one can fairly say that at least for the next 6 months, investors are expecting the German economy to boom ahead, to steam ahead. And that is also because, of course, the developing world is doing very well. We were just talking also about India, because Mr. Modi was speaking in Davos. India is doing very well. That's what the IMF is also saying. And if the developing world is doing well, then it's also very positive for Germany, because we are obviously exporting so much goods to the world. And it's directly felt as well in Germany if other parts of the world are taking a dip. So for now, it looks very rosy here.
Well, thank you very much, Annette, for your time. Enjoy the rest of the day.